Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and here's wishing all the viewers of Business Today Television a very happy Independence Day. Today, as we celebrate the spirit of freedom and incredible journey of our country, we also bring you this special edition that's actually focused on a very personal and a very powerful kind of independence. We're going to be talking about financial freedom. Our guest today is also one of India's most popular voices when we talk about personal finance. He's none other than Pranjal Kamra, the CEO of Finology. And this Independence Day, we're going to help all of you understand from him what is that financial freedom formula that he swears by. Warm welcome to you, Pranjal. It's a pleasure to have you with us and happy Independence Day to you too.
Oh, thank you so much for inviting. It's a pleasure. I'm honored. And thank you so much for considering me worthy. I'll try my best to add value to your viewers. And yes, happy Independence Day to you and all your viewers.
Thank you so much. And financial freedom is very, very close to your heart as well. In fact, you've also named your company after financial freedom as well. You made so many videos, Pranjal, that millions of young Indians, look at, consume to really understand how to take control of their finances, invest wisely, and of course, build wealth for a secure future. So let me just start off by understanding from you, what does financial freedom really mean to you? And for an average Indian individual, what should be the starting point of understanding what is financial freedom?
Right. So, the absolute, if I break it down, the absolute basic definition of financial freedom is that you don't need to work in order to run your household expenses. So, you have planned your finances, collected enough money in a way that you don't need to work for money. You will only work the amount you want to on projects you want to without worrying about how will your household run. So not worrying about where will my money come from to pay
Yeah.
bills is financial freedom.
Okay, not worrying about your everyday expenses or your lifestyle expenses or whatever that you need to spend on. You should not be worried about where will the money come from, and that's the idea of financial freedom. Great point to start off with. But I want to also help all our viewers really understand. A lot of people get stuck by starting with the goal of, yes, I want to achieve 100 crores, I want to achieve a 50 crores sum, without understanding how much is enough and how much is too much. So how do you arrive at that figure of what will help them see that, yes, this is the figure that will help me achieve financial freedom? How do you start off with that?
Right. Very good question. In fact, I see a lot of Gen Z going overboard with it. Being too aggressive about it, or maybe obsessively thinking about it due to how popular influencers have made it. The FIRE
Yeah.
concept, financial independence and retire early. And sometimes I think apart from the sum, the arriving at the right sum that you need to become financially free, there is also a right sweet spot, the right age about when you should be financially free. So,
Yes.
sometimes I think that, people, I see videos online where people say retire at 30, retire at
Yes.
35, 40, and that makes me worried. It makes me think if you retire at 40 and you are going to live till 80, ki 40 saal, what will you do, next 40 years?
And also
Because,
create anxiety in the other part of people who are already 30 and 40, saying that we've missed out on that opportunity
yeah,
completely.
absolutely. A lot of entrepreneurs that I talk to, a lot of people who become really rich at 30, 35, there's a common pattern. They'll always tell you that after hustle, after burning out, after working 18 hours a day, financial freedom, retirement feels great for 6 months, maybe a year, and then they get back to work because it gets really repetitive doing nothing every day. So I think there's also a sweet spot wherein you plan your finances in a way where you don't have to work till 70, 75. But also, if you are planning to retire at 30, 35, one, even if you manage it, what will you do for the other half of your life? And two, that makes your 20s and 30s really miserable because you always feel that you are on this treadmill and you have so less time available. You have to squeeze out every penny, save everything, and it makes you really anxious. So I think the sweet spot of retirement, if you want it really, really early, would be 45 to 55, 60. So you decide
Okay.
where
Okay.
where that falls. Now, regarding the second part of your question, what is the right amount?
Yeah.
So broadly, just a general thumb rule, there's this 4% rule, wherein, you calculate how much amount you need by calculating that whatever your corpus is, if you withdraw 4% from it, your household expenses should run. So let me break it
Okay.
down with an example. So,
Sure.
for example, someone thinks that, say, someone's current expenses are 1 lakh rupees a month,
Yes.
and they are, planning to retire in 20 to 25 years. Roughly, inflation is 6.5% every year, which means the value of your rupee will half every 12 years. So,
Okay.
if someone is planning to retire after 25 years and their current expenses are 1 lakh, after 25 years, they'll roughly need 4 lakh rupees to
Correct.
maintain the same lifestyle expenses.
Sure.
So 4 lakh rupees a month means that roughly they would need to withdraw 50 lakh rupees every year from their corpus. Now
Okay.
that 50 lakh rupees should not be more than 4% of your total savings, which means that, 50 lakh rupees is roughly 4% of 25 crores. Sorry, 12 and a half crores. My maths is weak. So 12 and a half crores. So if someone's current expenses are 1 lakh rupees a month and they plan
Yeah.
to retire 20, 25 years from now, they should plan for a savings of between 12 to 15 crores on the safer side.
Okay.
Once
Got
they
that.
reach that
Yeah.
figure, they are financially free.
Wow, that's a great way to put it. A simplified formula there for everybody to start off with. You see, calculate your own expenses, your own lifestyle expenses at this current time, add on the inflation, and then look at from your overall corpus as to whether you're withdrawing that 4% from your corpus and still having to have some savings at large, right? So, but a lot of people also get stuck that, okay, I have drawn this plan. You've given this formula, they will arrive at a figure 15 crores, 20 crores, 25 crores or 50 crores as per their lifestyle expenses. How do you reach that goal? Say somebody, we've been of course hearing that, you start off early and that's the best time, you start off in your 20s, start off even earlier than that. But for those who missed that initial 10, 15 years and are now hearing about that, you have to get started, we always say that, the best time is today if you've not started. So start now. So, how does one really start to achieve that goal then? What is the best way to start off with that?
Right. So, if someone is already, say, delayed by a few years, which I believe is the context of your question, someone in is already in their 30s, first five
Yeah.
years, 10 years, they've not gone down this route, then there are two ways to it. One is, can you push your retirement, 5 years further? Can you do that? So a lot of your past mistakes are then forgiven. So if you thought of, I'll retire at 50, can you retire at 54, 55? Can you make that compromise?
Yeah.
And that also incentivizes one more thing. When you know that you have to push your retirement by, say, 5 years, that also incentivizes you to slow down your aging by becoming fitter. So that also has indirect health benefits.
Sure.
So even if someone is 5 years delayed, it's not the end of the world. Another way to go about it is, can you lower your expenses by 10%? So if your current expenses are 1 lakh, can you bring it down to 85,000, 90,000? Because then that will have a huge impact on the overall retirement corpus that you need. So you bring down your corpus collection needs. Or maybe you can do a bit of both. You can push your retirement by 2 years, 3 years, and bring your expenses down by 5%,
Sure.
10%, which is doable for most families. So this is how they can make up for lost time, actually.
Okay. Now, to arrive at the corpus that you have highlighted for our viewers, how does one start and where does one, begin? Is the aim to earn more, to start looking at increasing your income? Just the way you pointed out, a lot of people are doing hustle culture, a lot of people are doing burnout, 18, 20 hours of work because they want to arrive at an early retirement age. So should that be the starting point, that how do I increase my streams of income, or should it be whatever income I have, I actually go and invest maximum of that money?
Brilliant question. So at a very early stage of your career, or when you're in your final years as a student, I always tell that the focus should be skill enhancement. So someone who's 20, 25, even 30, their primary job is to enhance skills so that they can earn a higher active income. Because the chronology should be right. Ultimately, you will save a portion of what you earn and you will invest a portion of what you save. So if you earn more, you'll probably save more and then probably invest more. So in the early stages of your career, instead of being obsessed about how do I earn, more passive income, squeeze out more returns from your investment, the saner thing to do is enhance your skills. Also, what happens is if you are in a position where you're not developing your skills and your active income is not increasing, you try to compensate that by taking excessive risks on your investments, which is what we see. Someone wants to retire at 20, 35, 30, 40. They obsessively invest in F&Os, intraday trade, betting
Yes.
apps, cryptos. So that makes your investment plan really aggressive, volatile, and one bad decision actually, erodes multiple years of compounding. So in the early years of your career, it's better to invest in your skills and focus on increasing your active income.
And when we come to know about the asset classes where your allocation should be, we've always heard a lot about diversification. You took the name of certain assets as well. For achieving a financially free future, what is essential that one should not miss out on? We see too many extremes happening. Pranjal, you would have noticed that in your own conversations. Our previous generation was big on FDs, RDs, maybe a PPF as at the most risky asset class that they would have probably thought about. Our current generation is now talking more about mutual funds, SIPs, cryptos, like you talked about as well. But what is a balanced way, and how should one really not miss out on one aspect and yet ensure that you are getting the best of all worlds?
Firstly, I really respect the kind of questions that Business Today TV and you are asking. I create content on this, and yet I've never had this good a flow of questions. So it's bringing out probably decent answers from me. Okay, so let's start because again, chronology is really important in financial planning. So the first step for everyone has to be a term plan. So I often tell that, when you get
Yes.
your first salary, it should have three shares, one probably temple or God, one to your mother, and the third to the term plan. That's the best use of your first salary. And there are reasons
Okay.
to it. Term plan is one contract that stays valid for life, and its premium is fixed in the beginning. So, someone who's 25 is taking a term plan that would last till 75 for 50 years. That person will pay the same premium. It will never
Yes.
increase. And the premium is lesser the earlier you buy it. So, which is why your first financial instrument
Investment.
should be a term plan. And
Perfect.
only a term plan, no money back, no fancy schemes. That's where you get a worse deal. So a pure term plan only for the members of the family who actually earn and who has or will have dependents in the future.
Sure.
That's step one. Once that is done, comes and roughly the cost for a term plan for a 1 crore term plan will be 1,000 rupees a month. So it's really affordable. Next comes your health insurance. The second, a difference between term and health is for health insurance, you include every member of your family, either by individual plans for them or a combined family floater plan, whichever makes more economic sense, because everyone can fall ill, anyone can fall ill. So, health insurance is for everyone. Roughly, again, a good 10, 15, 20 lakh family plan should cost you 1,000 rupees a month for your 3, 4 member family. So, your insurance needs are done in 2,000 rupees a month. And why is health insurance important? Because, you might invest in mutual funds for 5 years.
Yeah.
Everything that I'll tell later, you might do it. And one, God forbidden accident happens, a hospitalization happens, and all your savings will actually go to the hospital. So you will be back 5 years due to an unforeseen hospitalization. So any unforeseen risk that you can
You have
transfer
to
to the
eliminate that.
insurance company. from a small premium, please do that. Step number three, and this is where most people skip because they find it boring, is actually having an emergency fund. So at least 6 months of your household expenses. So if you earn 1 lakh rupees, I'm assuming expenses will be 50 to 70,000, somewhere in that range. So in that case, you need a 3 to 4 lakh emergency fund, either in a FD, which you can withdraw, a flexible FD, or maybe a liquid fund that you can withdraw the same day or other day.
Okay.
This will again protect you from a job loss, business crisis, or some unforeseen expenses. So that's the third step.
Sure.
The fourth step is, and this is the most compromised goal, is actually retirement planning, planning for your old age. When even if you want to, maybe your health or circumstances will not allow you to earn. What happens is, at in your 20s, 30s, retirement looks far,
Yeah.
and we often end up withdrawing corpus from our retirement fund to meet short-term, medium-term goals. And why does this happen? Because we often plan our retirement via instruments from which we can withdraw money. So if you're going to plan for your retirement via mutual funds, via stocks, via 1 year, 2 year, 5 year FD, you will end up withdrawing and using that money for mid-term, short-term goals. So the best way to plan for retirement is actually national pension scheme. A lot of people don't like that scheme because the withdrawal terms are really, really rigid. It's a very illiquid investment. But that's the greatest part of it. Even if you want to, most of the corpus you cannot withdraw before 55. And through that instrument only, you will actually end up saving for your retirement. Because after retirement, few reports state that more than 85% Indians regret that they did not save enough for their retirement. So you don't want that regret. And NPS might save you from that. So that's
Okay.
step four. Now, once all of this is done, is when you start with slightly fancier instruments for your goals. So for goals which are fixed, important, so goals like maybe buying a house, children's education, marriage, these goals are important. There will be a time when these goals will be, in the short term eminent. You have to pay. Maybe you can push marriage around for 2 years, but these goals are more or less fixed. And because these goals are non-negotiable, the best way to invest is mutual funds. These goals, but for goals that are more than 8, 10 years away, because
Yeah.
a securities market, equity market can be volatile in the medium term. So goals
Absolutely.
that are more than 10 years away, mutual funds are great. And with mutual funds also, the better hack is that if you have four goals, maybe have one SIP for each of your goals. That
That's a
brings you
brilliant idea.
clarity, that I need 20 lakhs for this in my fund A. Am I going the right path? Are my investments enough? What is the corpus now? So it makes financial planning easier if you have one
Yeah.
mutual fund for each goal. Now, once that is done, most of the things are sorted. Last two things remain. One, wealth creation. So you still have some surplus money coming in. Maybe,
Yeah.
your family sold some joint land, you got some surplus, some bonus, things like that. There are two great investment options for that. One, you can park a certain amount in gold ETFs. It hedges you against the volatility of equity. It hedges you against country risk. India's particular stock markets not doing well. Gold prices are decided globally, so it hedges you. So gold is great for wealth creation. Returns might be slightly lower than equities, but it'll hedge you. And the second is, goals that are more aspirational in nature and not compulsory, more optional goals. So, for example, a European holiday, a big US holiday, probably buying
Yeah.
your second or third car. That is where maybe direct stocks are a great option, because if you end up investing badly, maybe you'll not go to Netherlands, you'll go to Nainital instead. But it doesn't change your life per se. So only
Yeah.
that goal, only those goals on which you can compromise on. And even if those goals are not fulfilled, your life will not change materially should you invest in direct stocks.
Okay, brilliant. I think those are some fantastic five options that Pranjal has really broken down very, very simply for all our viewers. Each step by step as to how do you protect yourself first and then look at how do you create wealth for yourself as well. That's brilliant. Where would you put crypto or newer asset classes then, in case we have not covered that in the first five steps?
On the gambling section. Maybe 1%, 0.5% of your money if you really want to. But I would avoid it. Yeah.
You would avoid it. Okay.
Yeah.
Now
Yeah.
I've seen you, Pranjal, make a lot of videos on, even if you are at zero, it's not very difficult to think of a goal of 5 crores or 10 crores for yourself. How would you really explain to somebody who really wants to generate that kind of a wealth, a young person, a 20 something person or 30 something person wants to have that goal for themselves? How does one really start off?
Right. So, one mindset that anyone who's just starting out with zero income, a lot of people don't actually start because they think that, I can only save 5,000 rupees a month or 10,000 rupees a month.
Yes.
That's too low. I'll never reach my goal, things like that. And which is where, I bring in a lot of sports ideology wherein even if it's, say, cricket, badminton, hockey, football, all these sports persons say play the moment. Either play ball by ball, session by session, minute by minute. Don't think about the match, the series, the occasion, and things like that. I think it's the same with most fields in life, living in the moment. It's the same with financial planning. You can't be worried about 5 crores that you need 20 years down the line. You have to be worried about, okay, you are earning 40,000 rupees now. Can you invest 1,000 more? Can you invest
Yeah.
2,000 more? Instead of 5,000, can you invest 7,000? Because you have to understand that you never know how much you will be earning 5 years down the line. Maybe you will be earning really great. So it will not be 5,000 per month investments 5 years down the line. Maybe it will be 20,000. You can step up every year. Even if your increment is 7%, 8%, 10% every year, your SIPs will increase proportionately or maybe more. So you increase your investments 10% per year. Think it day by day, month by month, year by year. And also, uh, and I've experienced it personally also. So anecdotal evidence, a lot of data also. Uh, with Gen Z and millennials, our definition of basics, the number of subscriptions that we have, OTT
Yeah.
subscription, music subscriptions, credit cards, our definition of basic necessity of life is greatly exaggerated. Greatly
Yes.
exaggerated.
I
So
actually
I
wanted
think,
to come to that point, Pranjal, because
okay.
this is a generation that thinks about YOLO. You live only once. That's how it is brought in. So, how do you really explain to them that not everything needs to be instantly gratified, and you need to have something for later as well? And that's where I think your point is also coming to. So, how do you really explain to such people who say that I don't know what happens tomorrow. Our lifestyle is already very bad. We don't know whether we will live too long. So why do we compromise our entire present for the future?
Yeah, but I get this concept that we are young now, our bodies are fit, we want to enjoy life now. Why not travel, spend things like that? But and I've gone to an extent through that journey. This sounds really philosophical, but I think marginal utility of money decreases very quickly. So when you don't have anything, probably the first 50,000 a month that you earn is
Yeah.
invaluable. It's coming from zero to 50,000 a month, it's invaluable. That's 50,000 a month you need in India for probably survival, a decent survival. From 50,000, when you go up to 1 lakh rupees a month, now you're living a decent life, a very good life. 1 lakh to 2 lakh, 2 lakh rupees a month when once you reach, you can live a life as good as anyone unless you want to invest a lot in real estate, buy projects, buy flats in really expensive five-star housing projects and things like that. But beyond that, 2 lakhs to 5 lakhs, 5 lakhs to 10 lakhs, maybe your watch will change from Titan to Rolex, your car will change from Toyota to Mercedes, but it doesn't impact your life in any way except how you attach your self-worth with these things. So
Yeah.
I think it's really important to understand where you are spending, where not, what's necessity, what's luxury, what's important, and what's desirable. Because uh, In jobs also, we are seeing what's happening in the IT industry with AI
Yes,
coming
with
in, a lot
AI.
of layoffs. Business is volatile as anything, so you never know. So if your bare minimum threshold is higher and you end up meeting bad times, and you're not ready for it because your lifestyle, your monthly expenses, your fixed cost of living is so high that you scramble to meet those needs in bad times, and then we face anxiety, depression, addiction, and whatnot. So I think it's really important that we talk about businesses, and often businesses those who are asset light, whose
Yeah.
fixed costs are less and variable costs are decent, are valued more. They're valued at a premium because these businesses are considered flexible. And by flexible, I mean market tells them that these businesses are more in a situation to survive a bad time. I think it's similar for individuals as well. If your fixed costs are low and variable costs are more, I think that makes you asset light, more dynamic, more ready to face bad times, and it helps you in a situation where you are not in a situation to plan for your retirement. You
Sure.
have to push away your retirement, you have to live with lesser income. So I think that's very important. The simplest way
Yeah.
to start it, I did that exercise about 3 4 6 months ago. I listed down all the OTT subscriptions that I have,
Yeah.
my music, my Netflix, and things like that. And a shocking fact came that for listening to music and podcasts, I was paying for the same service thrice. So I had
Yeah.
YouTube Premium, I had Apple Music, and I had Amazon Prime. And all these three services allow me to listen to music. And I cut down on two, and I'm saving 500 rupees a month. I think these things
Fantastic.
add
Yeah.
up. You can, if you do that calculation, most households would actually end up saving 3 4 5,000 rupees a month on various subscriptions that are duplicate.
And that can be financially used as well. You
Yeah.
also did take the name of real estate. So I want to ask you, how are you looking at for the next generation? I think for the previous generation, that used to be the biggest, spending for them, that they had to have a house. They had to also look at a second investment as well. For somebody who belongs to the current generation and for the future generation as well, what is the importance of real estate investment?
Yeah, I have a boring answer here. I don't fall to the either extremes. There's this huge debate in the digital world. A camp is never own any real estate, live on rent, flexibility. The other camp is it's great, it's secure, things like that. I think I fall somewhere in the middle. For most asset classes, people come and ask me whether they should invest in gold, equities, or real estate, or which one should they prefer, and things like that. And my simple answer is whichever makes you comfortable. Because in the long run, be it real estate, gold, or mutual funds, more or less returns will be same. Maybe
Okay.
1%, 2% here and there. And there's a logic to that. You know, money looks for the best alternate opportunity. So if real estate returns become really, really low, what will happen? A lot of money will come out of real estate and will go to either gold and equities. And if a lot of money comes out of real estate will become cheap. So it will become attractive again because the future yields will rise up. So in the long run, on an average, in most cases, all three asset classes will give similar returns, 1%, 2% here and there. But here are the pros and cons of real estate. When I say returns will be similar, and when I say real estate, to me, real estate is one thing, it's land. Everything else is luxury. It's an experience. So I see people buying flats in five-star real
Yes.
estate projects
Yes.
where, if it's a 2 crore flat, the actual price of proportional land that's given to you is maybe 20 lakhs, but you bought it for 2 crores. So
Yeah.
other 1.8 lakhs actually goes on the structure, finishing, amenities, all of that will depreciate. So out of your 2 crores, maybe 80% of the amount that you paid will be depreciated. And when the next new projects comes in the next neighborhood of your project, which has 10 floors higher, better amenities, 10 years down the line, your house, which is now 10-year-old, the society is not maintained, it will be tough for you to find, a purchaser at a good price. So, so
Absolutely.
if you, so if you want to still live in that society, please bifurcate. Please understand that out of the 2 crores, maybe 1.5 crore that you have paid will not appreciate. Maybe 30,
Yeah.
40, 50 lakhs will appreciate. And I don't mind people, buying one property to live, because I have lived for 20 years in a rented home. I understand, Indians are emotional. There's a lot of stress attached to living in a rented house. So I understand if you want one house and you want to live, you want to own that house. But it should be clear in your head that it's not an investment. And second, buy one house. Then don't buy second house, third house, a farmhouse. No. If you're comfortable with real estate, keep on buying land. That's a good
Yeah.
investment.
That's a
Yeah.
good investment. Okay, I think this conversation can actually go on, and we can keep listening to you from your experience. But okay, last one word from you on the show before we end this fantastic conversation is the biggest learning that you would want to part to all our viewers who have just started on their journey of investing, so that they are not a part of those 90% who fail to build wealth for themselves. What is that one big learning that they should abide by always and keep in their mind when they start on this investment journey?
I think the most important thing in investing is investing in a way where you don't lose, where you don't incur negative compounding. Protecting your capital is the most important thing. Because
True.
think about it, gold on its own, on an average, grows by 10%. Real estate grows by 12%. Equity market in India in the last 45 years have grown by 14%. So all these investment options have a natural rate of compounding built into them. You want to be either be equivalent to that or more than that. But it's so unfortunate that in an equity market that compounds by 14% on an average, 97% retail traders actually incur a loss.
Yeah.
And this is, by loss, I mean they are at 0% or less. If I compare them with whether they meet or, or beat the benchmark, probably the figure will be 1%. So a lot of youngsters who are just getting started, they want to be in that 1%. And in that race, they end up being in the 99%, who either don't defeat the index or incur losses. So you don't want to take excessive risks. You want to be so you don't want to, take excessive risks. You don't want to be a hero. You want to have patience. You want to do it in a slow way, in a way, this rabbit tortoise story. You want to consistently run instead of being the fastest and the quickest.
Fantastic. Well, Pranjal, we'll thank you then for sparing such a wonderful 30 minutes with us on Business Today Television, explaining to all our viewers all the formulas that you have abided by and you guide all your followers as well with. Those key insights will, I'm sure, help all our viewers to really at least get started on all the points that they are still missing out on. And we hope that everybody at some stage is able to achieve all that they dream for when it comes to financial freedom. Thank you so much. It's been a pleasure to have you with us.
Thank you so much.
All right, with that, viewers, we wrap up this very special conversation. I hope this has given you enough and more insights on your journey to financial freedom. Do write into us, send us some feedback, send us your questions. What else would you want us to make videos on so that we can help you get the best of market experts, get the best of investment experts to help you take the best decisions when it comes to your money. Thank you so much. Here's wishing everybody a very happy Independence Day yet again.
If you like the video, do like, comment, share and subscribe.